Hi everybody, and welcome to our first video on Chapter 6, Cash, Fraud, and Internal Control. Here, we're going to take a look at internal control and why we do it a little bit, and define some terms, cash and cash equivalents. We have, as we do for all our chapters, some analytical techniques here, days sales uncollected, and we also, probably the most difficult piece of this is the bank reconciliation. And hopefully I can give you some hints on how to do that properly. All right, let's take a look. What is internal control and why do we do it? Internal control is used to monitor and control business activities. It includes your policies and procedures that protect your assets, ensure that people are doing their jobs in a reliable method, well proceduralized, and that we're basically upholding the company's policies. And if we do that, it should make everything more efficient. Sarbanes-Oxley Act, often called SOX, requires our managers and auditors of public companies to document and certify the system of internal controls. I was the SOX coordinator in my last position. I can't say that I love SOX, but at the same time, we did over 100 internal audits quarterly to ensure that we had our effective controls. And those audits had to be done by people outside of the finance group. So I had to teach all those people how to be auditors. And they evaluated our internal controls, and we report on those and see how well we're doing. The violators receive harsh penalties now, with up to 25 years in prison, largely as a result of the Enron and WorldCom situations that happened back in the early 2000s. And then those auditors, outside auditors' work, are overseen by the Public Company Accounting Oversight Board, the PCAOB. Okay, so the Committee of Sponsoring Organization, the COSO, lists 5 ingredients of internal control, which add quality to the accounting information. We have to have good control environment. We've gone through and assessed where we have risk, and the higher the risk that we have, the more we look to control those activities in a way that adds quality to our accounting information. And then eventually that gets translated to information and communication, and then we go back and monitor those items to make sure that we're continuously improving and identifying any areas that need attention. So internal control principles common to all companies. Really important that people know their responsibilities. I've just found in my experience as a CFO that if you don't tell people what you expect, don't be surprised that you don't get what you what you expect. So, good written procedures and good training are and then cross training to make sure more than one person can do those jobs in the case of something happening. And then we want to maintain adequate records. Very important. I audited a nonprofit out in Paris, California, and they were doing some good things. But the top guy there was so proud of the fact that he had he was proud of the fact that he had paperless environment. I said, well, that's great. And so, where do you keep your records? He said, what records? He hadn't kept any records. In his eyes, paperless meant no records. Well, he flunked the audit, obviously, and I helped him to get a system that had adequate backup for his journal entries and those kinds of things. So we want to insure our assets to make sure that if they disappear, it doesn't disappear from our balance sheet. And in some cases, we bond key employees. The only time I've been bonded is when I was a box boy at Bonds. That's been a day or two ago. But nevertheless, we want to separate, key point here, our record keeping from the custody of the assets. Because if you're responsible for record keeping and the custody of the assets, you could just write that asset off and take it home, right? So we want to divide our responsibilities, called segregation of duties, for related transactions, and I'll go through that in a few minutes, and look to apply technological controls where appropriate. And we'll discuss that as well in a few minutes. And don't expect what you don't inspect, right? So we want to perform regular and independent reviews. Again, responsibilities. They should be clearly established. They should be assigned to one person, and then we can determine if there is a problem, who's responsible. For adequate records, we protect our assets. We look for detailed records. We use the chart of accounts. Chart of accounts is a listing of all our general ledger accounts and a little description of each one. We use pre-printed forms with pre-numbered items, just like a deposit slip would be, or a petty cash receipt or something like that. And then our computerized point of sale system, where we are maintaining adequate records that way. So assets should be insured against losses. We spend a lot of money on our insurance, and a lot of thought goes into that as to what level of insurance we want, and we go from there. And then employees handling a lot of cash and other assets should be bonded. And I have many stories related to situations where maybe an employee's truthfulness was not executed properly. So bonding means that the company has purchased an insurance policy against theft by that employee. So from the standpoint of record keeping of assets, a person who controls or has access to the assets must not have access to that asset's accounting records. Pretty easy. So it reduces the risk of theft or waste of that asset. And to be able to, let's say, be a thief, you would need to collude with some other employees and agree in secret to commit fraud under this control. So that generally is enough to dissuade most employees from taking that risk on. All right, so we divide responsibility for related transactions to more than one individual, and that provides a check and balance on the other to prevent fraud or errors. We call it some segregation or separation of duties. Internal control, we're going to apply our cash registers, make an electronic file and a record of each sale. Time clocks for employees clocking in and out. And they may scan their badge or do other methods of clocking in and out of jobs or things like that. But still, we have a very exact accountability for that employee's work. And then ID scanners limit access to authorized individuals. So you can't get into certain places, etc. All right. Regular and independent reviews that helps ensure that our procedures are followed. It's preferably done by auditors not directly involved in the activities. These auditors evaluate the efficiency and effectiveness of internal controls. These auditors can be internal auditors or external auditors, as the case may be. All right, so here we're going to look at reducing processing errors by good internal controls, good training, good procedures, extensive testing of the records to make sure that we are getting what we expect. That often is done by outside auditors. We have new evidence of processing. We have increased e-commerce, and we have a separation of duties. So the increased e-commerce is its own little interesting area. Blockchain is a relatively new type of accounting ledger, and it continuously and simultaneously updates and verifies the ledger. Pretty nice. It prevents modification without detailed record of changes, and those changes cannot be destroyed or hidden. So the auditors are going to focus on testing the effectiveness of the company's blockchain processes and technology. All right. The limitations of internal control: nothing is perfect. There's no fail-safe system. There's always the possibility here of carelessness, misjudgment, confusion on the part of people. And sometimes the people go astray by intentionally trying to defeat the internal controls for personal gain. I unfortunately have many stories related to that, and so the fraud triangle is important in a way to identify the opportunity for that fraud. If you have an opportunity to commit fraud, it's going to be a lot more easily done. And maybe there's some pressure, and sometimes rationalization. Again, I have many stories on that, which I will not go through in this limited walkthrough of the PowerPoint. But rationalization, I'm always shocked at how people, when they're caught, how they look at themselves and how they rationalize their fraudulent behavior. Very sad. So we have to have a cost benefit here. I mean, the cost of internal controls can't exceed their benefits. There's no such thing as perfect internal controls. But it does cost something in time and money to implement those internal controls, and we want them to be worth the cost. All right, let's take a look at defining cash and cash equivalents and explain how to use them. Here we have an effective system of internal control that protects cash and cash equivalents needs to meet three basic guidelines. Handling cash must be separate from the record keeping for cash. Cash payments made by either check or electronic, and cash receipts are promptly deposited in the bank. That looks like a good place for us to stop this first video, and when we return, we'll take a look at cash equivalents, and liquidity. Until then, bye for now.